So I wanted to talk today about a small and seemingly simple part of the employee retention credit, one that's often overlooked, but actually has a lot of complexity below the surface. And that is, what is an eligible entity? And so why do I want to talk about this? Not because of the big broad brush pictures here, but because in certain situations, an eligible entity can have a significant impact on eligibility. And in particular, there's a portion of the employee retention credit called the recovery startup business. This has a very significant impact on. Let's dive into it. What is an eligible employer? Well, let me share my screen here, and we can see exactly what the NOS 2021-20 says as it relates to that. And so an eligible employer is quite simply an employer carrying on trade or business during calendar year 2020 that's fully or partially suspended due to or has a qualified significant decline in gross receipts. At first glance, this seems very straightforward. Any employer, well, we know the employer retention credit, you have to have employees, so you have to be an employer. You have to carry on a trade or business, and you either have to be fully or partially suspended or decline in gross receipts. Let's break this down a little bit. Fully or partially suspended, you can see here on the right-hand side of the screen here that on those 2021-20, which we're breaking down and analyzing, there's 102 pages on just this particular notice. And this particular notice just focuses on the 2020 time period. But it's the primary document that outlines the rules of the program. There are additional updates to it for different time periods, but this is the primary thing that we're focused on. And effectively, the vast majority of these 102 pages really talk about full and partial suspension. What is not a qualifying partial suspension? And then, or a decline in gross receipts, which we know decline in gross receipts is did your sales drop by a percentage. For 2020, you had to have a quarter that would drop by 50% or more compared to the same quarter in 2019. So this is an eligible employer. And really what we saw, a lot of folks who came in, a lot of these promoters who came in late 22 and throughout 23, blowing up the phones and the emails saying that everybody qualifies. Well, it's because they read this first section here and they stopped reading at this right here. They read that any employer carrying on trade or business during the calendar year 2020 is eligible, right? So they stopped and so they started saying, well, everyone's eligible because it says it right here. Well, we always know that's not the case. It's not so simple as that. But more importantly is there's two particular entities that fall outside of this, this traditional definition here that you might not necessarily realize qualifies as an eligible employer. So one is a recovery startup business, two is a nonprofit. So as you read through here, you can see that tax-exempt organizations are also eligible. 501c3s, tax-exempt organizations are considered a trade or business, which actually we're going to talk about the definition of trade or business in a second, but a key part of trade or business is that there's a profit motive. If you're a nonprofit, how can you qualify as a trade or business? Well, there's a special exception in the CARES Act for nonprofit entities. So the term trade or business is pretty straightforward, right? You're probably wondering, Brad, why are you talking about this? Like trade or business, if you have a business, you're eligible for employee retention credit if you meet a certain set of criteria. Interestingly enough, trade or business is actually a term that is not very well defined. It's actually had a lot of legal controversy over the ages, a lot of lawsuits around what is and is not trade or business. And so NOS 2021-20 reflects on this and recognizes this. And so the very first FAQ, the very first question on NOS 2021-20 is, well, what is a trade or business for the purpose of the employee retention credit? And so the answer states, well, two things. One, it's the same meaning as used in section 162 of the code. 162 of the code actually doesn't have a concrete definition of a trade or business. Now, the notice does go on to say that under 162, an activity does not qualify unless its primary purpose is to make a profit and it's carried on with regularity and continuity. And so 162 goes back to what is a deductible and non-deductible expense? What can you deduct? When are you allowed to deduct certain expenses from income? And so it explains the type of activities, but it doesn't clearly define a trade or business. And so what we look at here is, and then if we go further on in FAQ 1, is clearly outlining that tax-exempt organizations are deemed to be engaged in a trade or business. So despite the fact that a trade or business has to be engaged in a profit motive for the purpose of the employee retention credit, FAQ 1, makes it very clear that tax-exempt organization is deemed to be engaged in a trade or business. So what is a trade or business? So how do we know for trade or business? And again, why does this matter? Well, in particular, we've identified nonprofits are eligible based off this definition here, but for the purposes of a recovery startup business. And so I have a lot of other videos about recovery startup businesses. However, certain entities are eligible for additional tax credits into Q3 and Q4 of 2021. In fact, the only entity that's eligible for an employee retention tax credit, that is, in the fourth quarter of 2021, was you had to be defined as a recovery startup business. And a recovery startup business, the simple definition here is that simply that a recovery startup business has to have started operations after February 15th of 2020, and it had to create a new trade or business to be in operations after February 15th of 2020. Now now suddenly the definition of trader business becomes important. So why does it become important? Well, the IRS has been going and looking at fraud. They've been looking at fraudulent activities. Well, unfortunately, some folks took the employee retention credit as an opportunity to create a new business, hire a bunch of people, but without necessarily any profit motive. In fact, some folks would so far as to fraudulently create businesses, create fraudulent business, and create fraudulent employee records in order to say, no, we were a business eligible for the employee retention credit. So that's one big compliance reason. But the other one that's more interesting is, well, what if you are a business owner who currently operates a business and you opened up another business during this time? Can you be eligible? Well, as with anything, it depends. Can a new business be eligible? So let's say, for example, a restaurant, and that restaurant has been in existence since 2019, and it would qualify the partial suspension test. In 2021 or 2021, that business opened up a second location. Does that second location qualify as a recovery startup business? And potentially does the first location qualify as a recovery startup business under the aggregation rules? So as with everything, it depends. Let's take a look at, well, what is a separate trader business? So, and how do you define what a separate trader business is when it's not necessarily clearly defined? So there's a great article on taxadvisor.com that really goes into detail on this. And there's three key things that the courts and the IRS have looked at to determine whether or not a business is a separate trader business from another. So the first one, really the basic one, is do you keep separate books and records for each entity? Well, that's pretty straightforward, right? So that's kind of the first test, is that if there needs to be separate books and records for each entity. Now, that alone doesn't necessarily qualify it as a separate trader business, but that's really the starting point. So that's established in the rules and the guidance there. But then there's some court cases around this. So one of the most significant factors of whether there's a separate trader business is the similarity between the businesses, between the business activities. So for example, back in 1929, there was a court case on this, is whether this was a separate trader business. Same owner, but separate trader business. And so Martin Grocery Co. back in 1929, the courts determined that the operations of a grocery store and its cattle ranch were sufficiently different because it's separate trades or businesses. So you could see how, if you think about the supply chain, how a cattle ranch, cows go to the butcher, goes to the grocery store, how you can make the argument that these are two related activities, despite the fact that it's separate books of records and separate legal entities. So this actually went to court, and the court determined that these were indeed separate trades or businesses because of the similarity or dissimilarity between the business activity. How similar or different the business is has an important impact on whether or not it's considered a new trade or business. And then the other significant factor is what we call nexus. And so there's a court case around this as well. Nexus is probably the most important one to think about as you're thinking about, if I had a business, an operation pre-COVID, and then I opened up a new trader business post-COVID, is the nexus. And so, for example, this was a court case of Nielsen in 1973. So Nielsen, the court determined that the taxpayer operated separate trader businesses. They were in the hospital business, and they had multiple hospitals in multiple locations. And so the court reached the conclusion that even though the business was similar, that these two entities were indeed separate trades or businesses. And the reason that the court came to this conclusion is because the employees were different. The management was different. The hospitals in different geographic locations. They had different patients. And so there wasn't overlap. There wasn't shared assets. There wasn't shared employees. There wasn't shared management. There wasn't sharing between the two businesses. And so separate legal entities as well. The fact that these, even though the activities were the same, the fact that they were managed separately, they were in different geographic locations, the court determined that indeed this was a separate business. Again, why is this important? Well, as it relates to the recovery startup business, if a taxpayer started a new trader business after February 15th of 2020, they are potentially eligible for the recovery startup credit in Q3 and Q4. In these situations, for example, a restaurant that was in existence in 2019 opened up a new restaurant in a new location with a new set of employees and a new management system and a new set of operations, new assets, then it's possible and potentially even likely that the business would qualify, at least initially, as a recovery startup business. Now, the qualifications for recovery startup business in particular, there's aggregation analysis for revenues, and you have to be under $1 million of gross receipts on average for the past 3 years. So there's other analysis to do, but on a new trader business, that indeed appears that it could be eligible for a recovery startup credit. So wanted to share that with you. It's a little more technical and nuanced, but I like getting into this. I'm going to have more videos like this. This was just FAQ number 1. There's nearly 100 FAQs in those 2021-20. A lot to go through. Hope you found this useful. Thanks.